Hey everyone, welcome back to Corporate Decoder. Today Solana Company just filed an 8K announcing a registered direct offering, and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just sold a bunch of stock to raise money, but there is a twist with investor buy. Back options that we need to unpack. So, Solana Company, a financial services and asset management firm with a market cap around $122 million and about 21 employees, has just announced a significant financial move. They have completed a registered direct offering, which is basically a way for them to sell a lot of company stock directly to investors quickly. They announced this on the 27th of April 2026. This offering involves selling 3,076,922 shares of their class of common stock. Each share was sold at $2.60, bringing in an expected net proceed of about $7.9 million. The company plans to use this cash infusion for accumulating SOL, which is likely their cryptocurrency holdings, for working capital, general corporate purposes. Business expansion and other strategic initiatives. This is pretty standard stuff for a company looking to grow or shore up its finances. The offering was made under an effective registration statement, meaning it was a pre-approved way for them to sell these shares to the public market. The agreements they signed for this offering, called RDO purchase agreements, contain the usual clauses you'd expect. These include representations, warranties, and conditions for closing the deal. They also involve indemnification obligations, which means the company agrees to protect the buyers from certain liabilities, especially those related to the Securities Act, which is legislation around selling securities. These clauses were specifically designed for the benefit of the parties involved and are subject to agreed upon limitations, which is typical for these kinds of deals. Now, here's where it gets interesting. In connection with this stock sale, Solana Company also entered into what are called put option agreements with these same investors. Think of a put option as giving the investor the right, but not the obligation, to sell something back to the company at a specific price. In this case, each investor has the right to require Solana Company to buy back all or part of the shares they just purchased. The buyback price is set at the original offering price of $2.60, plus an amount that would give the investor a 7.0% annual internal rate of return. These buyback rights or put options aren't just available anytime. They can be triggered by specific events. These include the 12 and 18-month anniversaries of the stock sale closing. More importantly, they can also be triggered if the company's net debt to total capitalization ratio stays above 30%. This means if the company takes on too much debt relative to its overall financial structure, the investors can force a buyback. Another trigger is a suspension or halt in trading of the company's stock on its exchange for too many days, or if the company receives a delisting notice. These are all pretty serious potential issues for a public company. This structure is quite noteworthy. It provides a downside protection for the investors. They can get their money back plus a guaranteed return if certain negative events occur. This can be seen as a way for Solana Company to attract investors when perhaps the market confidence isn't at its highest, or to secure capital on more favorable terms than they might otherwise. It also introduces a significant potential liability for the company. If these put options are exercised, Solana Company would have to come up with a substantial amount of cash to buy back those shares, which could strain its financial resources. The company has also filed a legal opinion from its counsel, Cooley LLP, which basically confirms the validity of the shares being issued. This is standard procedure for these types of offerings. This unregistered sale of equity securities is being done under an exemption from registration, specifically relying on Section C, R3, and Rule Wooly-Nil of the Securities Act. This means they are selling to a limited number of sophisticated investors, likely institutional ones, who are deemed capable of evaluating the risks without the full disclosure required in a public registration. The company also issued a press release on the 27th of April 2026, announcing the terms of this registered direct offering. The details in that press release are mostly what we are covering here, and it is being furnished as an exhibit to this filing. It is important to note that this information is not considered officially filed for certain legal purposes, but it does inform the public about the company's activities. Essentially, this filing documents a capital raise activity. Solana Company is actively managing its capital structure and investor relations. This registered direct offering, along with the accompanying put options, is a strategic financial maneuver. The filing includes forward-looking statements, which are essentially the company's expectations about the future, including the proceeds from this offering and how they plan to use the money. These statements are subject to risks and uncertainties, and the actual results could differ significantly. The company makes it clear that they undertake no obligation to update these statements if things change. This is standard legal sire for companies making public statements. Now, looking at this from a broader perspective, Solana Company is a financial services and asset management firm. This type of financing, especially with put options, can be common in the venture capital or private equity world, but seeing it in a public registered offering is particularly telling. It suggests they might be looking for significant capital to deploy, perhaps into assets or strategies that carry specific risks or require substantial investment, like accumulating SOL. The inclusion of the put options at a 7% guaranteed return is a significant commitment. It is a safety net for investors, but a definite obligation for the company. This $7.9 million raise is a substantial sum for a company with a market cap of $122 million and just 21 employees. It represents a significant dilution of existing shareholders, with over 3 million shares being issued. The put options add another layer of complexity. If investors exercise these options, it would require Solana Company to either have significant cash reserves or potentially sell other assets to meet those repurchase obligations. Historically, companies that offer such investor protections often do so because they need capital urgently or are operating in a high-risk sector where investors demand more security. We've seen similar structures in the past, though perhaps not always with a cryptocurrency focus. The comparison here isn't a perfect one, but think about how some distressed companies might offer convertible debt with warrants to get funds, but this is structured differently with common stock and direct buyback rights. The risk for existing shareholders is that if the company doesn't perform well and the put options are exercised, they could see their stake bought back at a price that is higher than the market might dictate at that time, further impacting overall shareholder value. What I'm actually looking for is how Solana Company plans to deploy this capital to generate returns that can not only cover the 7% promised to these investors, but also provide upside for all shareholders. My biggest concern is the potential cash drain if those put options are exercised. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.